Okay, I've muted everybody. We can start the class now. Good morning once again. Today we're going to continue with where we stopped. For my physical students, last class, Paul came to the class and took you on capital allowance introduction. So we are still going to be riding on that to talk about the capital allowance elaborately today. Okay, I'm going to be sharing my screen. In case you have any question, do not hesitate to let me know. So I'll just do a brief overview of what we did in last class. For my physical students, you have your study material with you. You can quickly open to where we have capital allowance. Okay, we said capital allowance is the allowance granted to a taxpayer that has incurred qualifying capital expenditure and put it to production use at the end of the basis period. And I gave you the reason why capital allowance was actually introduced by the tax authority. I said, assume a company that has two assets, the different company acquired two assets differently, but they acquire it at the same date and put it to production use at the same date. There's every possibility that this type taxpayers will be charging different amount of capital depreciation, owing to the fact that the two taxpayers are using different different accounting policy, and that will make them charge different depreciation. I also gave an instance. Imagine two companies acquire the same assets and put them into production use, and the asset they acquired for 10,000 naira. Company A acquired it for 10,000 naira, company B acquired it for 10,000 naira. At the end of the day, the two of them, let's also assume that they apply different depreciation rates, the same depreciation rates rather, 10%, 10%. Let us also imagine in our mind that these companies, because of the accounting policy they have adopted, they are adopting different accounting policy. The accounting policy here says, I am going to be charging depreciation using reducing balance method for this first company. For the second company, I'm going to be using straight line method. Now, you remember that in calculating depreciation for straight line method is on cost. And you remember that in calculating depreciation for reducing balance method is on book value. At the end of the day, these two taxpayers, even though they have acquired the same asset and put to production use, even though they have also acquired the assets and also use it at the same time, they will not be able to charge the same amount of depreciation because they have adopted different methods. Okay, a call came in, sorry. I have to quickly mute. So I was now saying that these two companies will be charging different amount of depreciation because they have adopted different methods. Therefore, we now say capital allowance granted in lieu of depreciation, that is, instead of granting depreciation or allowing the taxpayer to claim depreciation as relief, or capital allowance is now being granted to the taxpayer. So that is that. We quickly move to the types of capital allowance that we have. We said we could have initial allowance and another allowance, and balancing allowance will only arise when there is disposal. So we might not really call that the type of capital allowance. Initially, before now, a company that acquire plants, equipment, and machinery were usually being granted what we call investment allowance. But with effect from 2023 tax year, investment allowance would no longer be applicable. Okay, so that's why we did not talk about that. So we talked about the future of capital allowance, where we said it is calculated using standardized statutory rates. The method of application is uniform and consistent to all taxpayers. Equal amount of money will be claimed by the taxpayer, provided the assets were acquired and put into production use at the same period, and the costs are the same. The same set of rules are applicable to the taxpayer. Now, what are the benefits that the taxpayer could gain from claiming capital allowance? One of the benefits is that The capital allowance enables the taxpayer to have what we call tax benefit or savings. Again, it also reduces the taxpayer's liability. It improves the cash flow, and this will enable the taxpayer to be able to use the money that is being recouped from the capital allowance to invest in the business. And that is why I said here that the amount saved as capital allowance can be plunged back into the business, and there's possible refund or repayment of tax liability to the taxpayer, repayment of taxes. Now, this possible refund would only occur when a company ceases operation. One of the things I told my online student last week was when a company ceases operation, the company has rights to carry backward its capital allowance for a maximum period of 5 years against the profit. So that is possible refund. So they have paid tax, they have paid tax liability, and unfortunately, when the company ceases operation, they are unable to recover the capital allowance that is left. So the Tax Act gives the taxpayer this right to go back in time to recover the tax liability that they've incurred. Sorry, the capital allowance that they've paid. So they would take it against their profits. Okay, so that is that. So we talked about the conditions for granting capital allowance. I'm very sure for those of you online, Paul would have also told you the conditions for claiming capital allowance. Note that this topic, whatever I stop today, is where I'm going to continue from in my class with you. So for those of your colleagues that are not in class, I don't have any issue. I'll just continue. I will assume that we have done this topic. So if you have any question, please ask the question now. So we move ahead.
Hello, sir. Good morning. I have a question, sir.
Go ahead.
Yeah, please, regarding the investment allowance. So my question would be directed to that aspect. What if investment plans is being purchased in 2024 now, since it is now being abolished in 2023? How do we effect that?
It is no longer applicable to the company. You cannot claim investment allowance on it again.
What if such is being put in the question? I'm just asking, how do we, because the last question we treated in class, such items was purchased, and what we just did that we applied the 10% rate. But the question now is, if it's being given and it's being purchased prior to 2023, how do we affect? How do we treat that?
2023, you are going to claim investment allowance 10% on plants, equipment, and machinery prior to 2023.
Okay. Thank you so much, sir, for that, sir.
You're welcome. Any other question before we move ahead?
Yes, sir. I have a question. In addition to what he asked, good morning, everyone. In addition to what he asked, assuming in an exam, they get such kind of question came in, and it's maybe for 2020, 2021. Are we meant to apply it or not to, since it has been abolished into 2023?
Yes, you will have to apply it for 2020, 2021, 2022. And one funniest thing about investment allowance is that it is granted once in the useful life of the assets. Okay. So, but my expectation would have been that the examiner will try to avoid this kind of complexity in setting up their question, this diet. Do you understand? Because at the end of the day, if you, as what's it called, as a student, sees question that borders around investment allowance, that is, when the company acquire plant equipment and machinery, ordinarily you're supposed to calculate 10% of the costs, and that would not affect your tax now value. You just have to calculate it and use it, provided the assets is acquired or was acquired before 2023. So I'm also going to bring up a scenario question where we're going to test that. But hopefully, I don't expect the examiner to test that aspect. But I would make sure I bring up a scenario that we're going to test that. Okay, let's
Thank
move
you.
on.
Yes.
So I have a question, please.
Go ahead, please.
So you said something about carrying backwards capital allowance after cessation. How does that work since the business owner must have paid tax already on their profit? So how did they carry back the capital allowance after cessation?
Thank you. So that is also one of the tax planning initiative that the tax law also allows. Okay, it is a tax law that allows it. It's in the tax law that when a company ceases operation and they have unrecouped capital allowance, they can go back 5 years before the year of cessation and take advantage of all the profits that tax has been paid upon. So all the taxes they've paid prior to that period will be recovered from the tax authority. We know that in Nigeria, a lot of these things does not happen, but that is what the law says, and that is what should happen when a company ceases operation and unable to recover its capital allowance. Do you understand?
Yes, I do. Thank you, sir.
Yeah. You can move ahead. So, as I was saying, I said we have conditions for granting capital allowance. One of the conditions is that the expenditure that is incurred, the person that is making the claim must be the one that owns the assets. Okay, expenditure must be incurred by the owner of the asset. Owner of the asset is very important because we could have two owners in the case of leased assets under the finance lease and under the operating lease. It depends on the kind of agreement that the company has. You know, under the operating lease, the what's it called? The lessee does not have rights over the assets. Okay. Meanwhile, under the finance lease, the lessee have rights, and at the end of the lease agreement, could be given an option of acquiring the assets. So, in that, there are different treatments on those two aspects. So, we are saying that the owner must not be in dispute. We must know clearly who is entitled to the capital allowance before it's being granted. The next one is the person making the claim must be the beneficial owner. We have said that. The asset must be in use at the end of the basis period. We have said that. So the assets must be in use at the end of the basis period. So that is another thing. A claim must be made in writing and forwarded to the tax authority before it could be claimed. The next one is that where the value of the capital allowance, capital expenditure is more than 500,000, and acceptance certificates must be obtained from the Industrial Inspectorate Division of the Federal Ministry of Trade, Investments, and Investments. So that is that. So we move on to the next thing that we talked about in my last class. We talked about when an asset is acquired on second-hand basis. We said this would occur in two scenarios. When building is acquired on second-hand basis, how do you treat the building that is acquired on second-hand basis? We said no initial allowance will be granted on that building if it is acquired on second-hand basis. However, the annual allowance will be granted on the building will be lower of the original cost of the assets of the building and the new purchase price. Lower of the original cost of the building and the new purchase price. So, say for example, if a building was acquired for 10 million by its first owner, okay, and it is now being sold again to another person. In terms of calculating your annual allowance, you're going to be comparing the price at which the first person bought it and the new purchase price, the second person bought it. So we're now saying We compare the price and we take the lower of the two and calculate annual allowance on it. Now, note that where the assets, the building has not been used before for the purpose of generating taxable income, it has not been used before for the purpose of business, then initial allowance could be calculated on it. We move on to the next one, other assets. Other assets that is not building, where other assets are acquired on a second-hand basis, both initial allowance and annual allowance can be claimed on it, provided that, one, the assets in question have not been used for the purpose of generating taxable income. Two, the asset acquired are at arm's length, that is between unconnected or unrelated parties. Note, however, where this transaction is between connected parties, no initial allowance will be granted. The annual allowance will be granted shall be based on the unexpired useful life of the assets. The annual allowance will be granted shall be based on the unexpired useful life of the asset. We move on straight to the next one, which is assets qualifying capital expenditure. Now, we have also talked about this. These assets will be acquired, assets will be in use at the end of the business period. The assets must be in use at the business period. Okay, so that is that. So you must, at every point in time, use these assets before you can claim capital allowance on it. Before you can claim capital allowance on it. So if you don't use it, any temporary disuse will not allow you claim capital allowance on the assets. So you must, at every point in time, use the assets. We move on to the next one. We say qualifying capital expenditure. What do we mean by qualifying capital expenditure? Qualifying capital expenditure is capital expenditure incurred for the purpose of earning income and which qualifies for granting of capital allowance. So is the asset that you have used for the purpose of earning income. So that means not all the fixed assets will qualify for capital expenditure, for capital allowance. Why? Because they must be seen to have been used for the purpose of generating income. They must have been seen to be used for the purpose of generating income. And that is why your private building, where you are staying, which is not for the purpose of earning income, which is not for the purpose of business, will not qualify for capital allowance. So imagine a landlord wants to claim capital allowance on his building. That would not be granted, except if he can show us evidence that the building is used for the purpose of generating taxable income. And if that is the case, in terms of this guy is paying tax on the rent he's collecting, then the taxpayer, that is the landlord, can claim capital allowance on it based on the provisions of personal income tax. Based on the provision of personal income tax. So that is that. Now, reason for exempting some assets from capital allowance claim. Number one, unlimited nature of useful life of an asset. Land is an example of that. Land does not have useful life. Therefore, we will say land does not qualify for capital allowance. However, under examination condition, examiner usually make this error by saying land and building. When you see land and building, just go ahead and treat it as building, okay? And follow the all provision of building to calculate your annual allowance and initial allowance. The next one. Some assets.
Excuse me, sir.
Go ahead.
So what about a situation where they said land and building, and at the footnotes, and they gave the price of the land and the building? Is it possible we separate it?
Yes, if that is the case, you will separate it. You just go ahead and take the building. I like your question, madam. You just go ahead and take the what's it called? Only the building, because land does not have expiry life. It is unlimited. Okay. Some asset can be subject to specific legislation, and this restricts them from capital allowance. Take, for example, building used for residential purposes or assets with private use might be limited in terms of capital allowance claim. So I'll explain that in terms of our capital allowance claim might be limited. The next one is company policy might also affect how we recognize some assets. Take, for example, staplers, perforators. We know that those things we could call them assets. But again, some company might say, I'm categorizing this straight, I'm expensing this because it's very small. How will you be bothering yourself? Or say you want to be calculating capital allowance on perforator, stapler. No. So most of the time, company expense this, and it's okay to do that. So we have some types of qualifying capital expenditure, which you already have the notes. Go ahead and read it on your own. So just like I said the other time, we talked about the initial allowance, the annual allowance. What is initial allowance? Let's start from that. An initial allowance is the allowance granted for all qualifying capital expenditure when it is acquired. So that is, when an asset is acquired, you grant initial allowance for the asset. You grant initial allowance for the asset. And by implication, that means you don't restrict initial allowance. You don't restrict initial allowance. Initial allowance is calculated in full. So when an asset is acquired, the first thing we do is we calculate initial allowance on that asset, and we calculate it on the full amount of the asset. Now, we have explained this asset between related parties. We have explained it before now. So the next one is, what are the characteristics of initial allowance? We said it is granted in the first year of use of the asset. It is calculated on the agreed cost of the asset. It is granted once. So you grant it once. You don't say you want to take it forever. It is granted once. And it is granted in full, irrespective of the number of months in which the assets will be used for the business. So you grant this in full. Any unabsorbed capital allowance in the year of assessment can be carried forward. So if a company is unable to recover its initial allowance, you can also carry it forward. The next one is annual allowance. Annual allowance is allowance granted to a taxpayer that has incurred qualifying capital expenditure throughout the useful life of the asset. Throughout the useful life of the asset. So, and it is calculated on straight line method. So, for annual allowance, you restrict the capital allowance to the number of months in which the company enjoyed it for. For example, in a particular year, if a company does not have the use of the asset for a full year, such a company will restrict the capital allowance, okay, to the number of months in which the asset is being used for. Now, you calculate capital allowance till you fully utilize the assets. So, and this is how to calculate capital allowance. We say to calculate your capital allowance is going to be cost minus initial allowance divided by number of years. Cost minus initial allowance divided by number of years. So now this situation is used where the basis period in which the asset was acquired is up to 12 months. That is a full year. So you use this method. But where your basis period is less than 12 months, you use this method. And this would only occur in a situation where the company did not commence business on time. So it's, for example, in the past, you remember when the company commences operation, we say from the date of commencement to the end of the first accounting year. So if that is the case, the company would also need to prorate the annual allowance, because at that instance, the company cannot enjoy full claim. So what do you do in the second year of use? You need to restate the formula back to this, because in the second year of use, the capital allowance would have been up to a year, because the basis period in that second year of use will be equal to 12 months. So that is that. So we look at what we, in the last year of use of the asset, you must retain what we call residue or nominal value. Now, this residual value is 10 naira according to the law. It's 10 naira according to the law. You must retain that according to the law. So that is that. So that means in the last year of use, your annual allowance will be equal to tax-free now value minus 10 naira. We have talked about finance as implication on investments and rural investment allowance is no longer needed. So I will also want to read all these tax allowances that we have. The next one is for us to look at the table. Examiner will give us this table under the examination condition. It is now left for us to be able to identify the one that is relevant to us. Now, qualifying building expenditure, you have this. Qualifying industrial building, you have this. So under examination condition, when you are given question capital allowance, all you just need to do is to go ahead and look at the table at the back of your question. Don't cram. Don't cram it. Okay? So that is that.
Sorry, sir.
Yeah, go ahead.
What's the difference between qualifying industrial building and qualifying building?
This is office building. This is factory building.
Okay. Yes, sir.
All right. So, but I still want you guys to read the definition of all the capital allowance, and you will see everything here. You will see everything here. Okay? So we move ahead. So the next one that we're going to be looking at is basis period for capital allowance. Basis period for capital allowance. Now, when you're talking about basis period of capital allowance, basis period of capital allowance is needed for us to be able to allocate our assets. Basis period for capital allowance is needed for us to be able to allocate our assets to the relevant year. And by implication, what that means is that it is not all the assets that will be introduced in a particular year. Some will be introduced in a particular year, while some will be introduced in other years. Now, what that means is that it is a basis period that would make you know where you are to introduce an asset acquired. So if I acquire an asset this year, it is a basis period that will let me know where I am going to introduce the asset for the purpose of capital allowance claim. So one of the things I also told my class last week is, if you had acquired an asset prior to the date of commencement, such will be deemed to have been acquired on the date of commencement. So that is that. So let's look at an illustration. I've done this illustration before. I'm not going to do that. I'll do the next one that I've not done before. Okay. For those of you that were not in my class last week, let's quickly run through this information, because I quickly want to go to another thing. So we said Jessica Venture, a sole trader, commenced business on 1/4/2015 and prepare account to 30th/6 annually. The following assets are acquired by the company on the dates shown below. So we have motor vehicle, 1 million. We have the date of acquisition, 1/2/15. Don't forget this company commenced 1/4/15, but it acquired asset before the date of commencement. From what I just explained to you now, I said such an asset will be deemed to have been acquired when the company commenced operation. The next one is plant and machinery. Plant and machinery was acquired 1/10/2015 for 1.6. So, and this other one. So you are now required that examiner now asks you, how do you assess qualifying capital expenditure acquired prior to the date of commencement? Any qualifying capital acquired prior to the date of commencement shall be deemed to have been acquired on the date of commencement. The next one. Now say prepare asset allocation schedule from 2016 to 2020 year of assessment. Compute the capital allowances claimable on the assets of 2016 to 2020 year of assessments. Now, we have explained that number one. Number two is for us to now do our asset allocation schedule. Asset allocation schedule. For our asset allocation schedule, that is where we are going to put our basis period and also use that to allocate our asset to the relevant year. So you remember, when a company or business commences operation, we said such a business will be assessed with tax from the date of commencement to the end of the first accounting year end. The second one will be from a day immediately after the end of the first accounting year end to the end of the second accounting year end. The next one will be a day after the end of the second accounting year end to the end of the third accounting year end. And in the fourth and subsequent ones will be on preceding year basis. Now, if we go by that, this business commenced operation 1/4. I will say from the date, and the accounting year end of this company is 30th/6. So I will say from the date of commencement, 1/4/2015, to the end of the first accounting year end, 30th/6/2015. The next one, a day immediately after the end of this one will be 1/7/2015 to 30th/6/2016. A day immediately after this guy will also be 1/7/2016 to 30th/6/2017. And that is what we're going to do for the remaining of the assets. Now, if that is the case, we can now go ahead and look at the assets. When was each of the assets acquired? The first one was acquired 1/2/2015. I'll go back to my basis period. Where would that fall? You remember, it will fall here because we said any assets you acquired prior to the date of commencement will be deemed to have been acquired on the date of commencement. Therefore, motor vehicle will be deemed to have been acquired on the first tax year. Any question before we go ahead?
Yes, sir, I have a question.
Right.
For the assessment here, I was thinking that this motor vehicle, like this one that is acquired, within this period that is stated there, how do we? I think that for the assessment it would have been in preceding year basis, and like you rightly told us before. Then why must we now bring it in here for that very first period of the basics period?
So what is governing our principle, just like I told you in class, is preceding year basis, right? Now, even though we know it's a preceding year basis period, there is also another principle that says if we acquire an asset prior to the date of commencement, that asset will be assumed that we have acquired on the date the company commenced operation. This company commenced this date, right? Now, what is our basis period? What is our tax year? Our relevant tax year for this period? Our relevant tax year is 2016. So we would have to introduce this asset on the first day of commencement of the company. Hope that is clear, madam.
No, sir. What I'm asking is that granted that it's going to be introduced on the very first period of commencement of the business. For the assessable year, the period for the computation of the tax liability, is it not going to come under the preceding year basis for the computation?
This is preceding year basis.
Okay.
Abi now, madam. When you look at
yes, 2026, yes, it is, sir.
It's preceding year basis. All right. Any other question?
I equally have questions, sir.
Okay, Adi Fowoshe, go ahead.
Yes, as regard this qualifying capital expenditure. So when in the case whereby we have motor vehicle, and we understand that we have classes of assets, whereby we have, if a company has that of motor vehicle and equally has delivery van, but this delivery van is being purchased not not the actual year or preceding year, but after the commencement of the business. So because the last question that we treated, there was this little issue whereby we have motor vehicle and other asset that's related to, but this was classified differently. But I was of the opinion that since for the fact that it's the same classes of assets, then we should have that motor vehicle, and that additional one being purchased should have been after that year, but it was being classified entirely. So I just want you to throw more light on that, sir.
So what I'm saying here is, even let them name it various name. Let them give whatever name. Okay? Let them give whatever name. Motor vehicle, delivery van, and whatsoever name. Lorry, let's call it lorry. Let them call it tractor. Tractor will fall under plant and machinery, but for motor vehicle, cars, all those will be categorized as motor vehicle. Delivery van will be categorized as motor vehicle. And the same rates will be applicable. Okay? So if they are acquired the same year, and you don't want to confuse yourself, put them separately. Okay? So put them separately, but the same year, the same principle will be, the same rate will be applicable. But put them, so don't say you want to add it together to avoid confusion. Because there could be a situation where one of those assets is eventually disposed. Okay.
Okay, sir.
Yeah, that is that.
Okay. Thank you for that, sir.
All right, any other question? Okay. So we move on. The next asset was acquired on 1/10/2015. When you look at our table, where would it fall? Would the assets be introduced this year? The answer is definitely no, because 1/10/2015 is not within this period. But when you look at this period, 1/10/2015 is within this period. Therefore, we can actually introduce that plant and machinery in this period. The next one that was acquired, it was acquired 1/10/2016. When we come here, 10/8/2016 is not here. We cannot see it yet. But 10/8/2016 is within this period. Abi, within this period, 10/8/2016 is within this period. So we can probably say, we can confidently say rather that the asset was acquired in this period. Now, we have been able to allocate the asset to the relevant years. The next one for us is to go and calculate our capital allowance. This rate that I've used here, I have used individual rates. Why? Because this company, this business is an individual. So, but for your level, it is company that we're going to be doing. I just want to use this as an example. Okay. So let's go. Now, the first asset that was acquired for 1 million. It was acquired for 1 million. How do you calculate our initial allowance? Initial allowance is 25% of 1 million. We have 250,000. That one is straightforward. It's just on cost, 250,000. Annual allowance is calculated by saying costs minus initial allowance divided by number of years multiplied by y over 12. Why did we use this formula? We have used this formula because the basis period we have here is not up to 12 months. It's not up to 12 months. That is why we have used that y over 12. Now, our n, how do we get our n? N is equal to 100% divided by annual allowance rates. I'll say it again. N is equal to 100% divided by annual allowance rates. That is your n. Okay. So that is that. So I will now introduce it. I'll say 1 million minus 250 divided by 5. N is 3 months. That is from April, May, June. That is 3 months. So I'll say 3 over 12 multiplied by 375. Sorry, multiplied by whatsoever answer we get from this. It will give me 37,500. For those of you in my physical class, please remind me to send this material to you. You are going to need it. I'll send it to you. So we'll move on to the next one. So how do we get our tax written down value? Our tax written down value is your cost minus initial allowance minus annual allowance. So we have 712,500. 712,500. Mute your phone, isn't it? Okay, 712,500. Now, in the second year of use, we acquired plant and machinery. So we need to go and calculate that too. But note that plant and machinery that was acquired, the basis period for that period is 12 months. We are not going to prorate the annual allowance. This is not depreciation. If it were to be depreciation, you would have prorated it to the number of months in which it was used in that accounting year. This is not depreciation. This is capital allowance. In capital allowance, we deal with basis period. Okay? So that is that. We deal with the basis period. So the basis period is what we are going to be looking at. So it will now be 110, 116 to 30, 17, which makes 12 months. So I'm not going to prorate my annual allowance. So I'll say cost. This is supposed to be up here. Cost. Okay, sorry, this is it. Cost 1.6 million. What is the rate of annual initial allowance? 20%. 20% of 1.6 gave us 320,000. So I will add everything. I will bring it to capital allowance column because this is my capital allowance column. The same thing with the first one we did. Add everything vertically. This plus this plus this will give you 250,000. This plus this plus this will give you 375,000. Add these two together horizontally to get your 287,500. That is your capital allowance for that year 2016. Now in 2017, our initial allowance is 320,000, but our annual allowance, we need to go and recalculate our annual allowance. So let's go in calculating our annual allowance. So our annual allowance for motor vehicle needs to be recalculated because in this second year of use now, we now have 12 months. So I will say my cost, which is 1 million minus 250,000 divided by 5, I will have 150,000. That's how I got this 150,000. So annual allowance, 150,000. The next one. I need to also calculate annual allowance for plant and machinery. Annual allowance for plant and machinery is equal to cost. Write it down. It has cost there. Write it down. It's equal to 1.6 million minus 320,000. How many years will this asset use? 10 years. Divided by 10. You will have this. So having gotten your answer, you will add 150 plus 128,000, you will get 278,000. So add these two together, you have 598,000. We move on to the next year. So we need to get our tax now value. Our tax now value will be this minus this. It will give us this. Our tax now value for this one will be this minus this minus this. It will give us this. I go back again. Our tax now value for this first asset will be 712,500 minus 150,000. You will have this value. For the second one, you will have 1.6 million minus this will have this value. Okay. In the third year, we acquire another asset, which is furniture and fitting. So I come to my column, my furniture and fitting is 3.6 million. Initial allowance, 15% of this, 15% of the cost, I will have 540,000. I will add the first column, second column, and third column together to get my answer. Now, you remember one of the things I told you about annual allowance is that it is constant, provided that you did not prorate anyone. So that means I am still going to have the same annual allowance I've calculated for these two. It is constant, okay, because the straight line method is constant. We need to go and calculate annual allowance for this guy too. In calculating annual allowance for furniture and fitting, it will be cost this minus this divided by how many years will this asset use? 10 years. So divided by 10, we have 306,000. So let's go. There was an error there. It's supposed to be 20%. Let's go. Let's check. It's supposed to be 10%, but I recognize 20% in error. So this is supposed to be divided by 10 years, not 5 years. Okay? So, but let's assume, we are just assuming now, let's assume it's 20%. So I will just have this. I will have this. Okay? So, and that is what we will continue to do for all the assets. Now, again, just like I told you, because annual allowance is constant, it will always remain constant. It will remain constant. All you just need to do is to be getting your tax now value for every year. So my tax now value after this year for this one will be this minus this, I get this. For this one, it should be this minus this, I get this. For this one, it is this minus this, I get this. It is this minus this, I get this. Do you understand? Now, another thing that you need to know is in the last year of use, this asset is supposed to use 5 years. So in the last year of use for motor vehicle, which is this is the last year of use, it has used year 1, look at it. 1, 2, 3 for 2018, 3, 2018, 4, 2019, and in 2020, which is the last year of use, your annual allowance will be equal to your tax now value. In the last year of use, annual allowance shall be equal to what? Tax now value. But we must retain 10 naira, so we remove 10 naira from it so that we can have 10 naira as our balance. This 10 naira is needed when you want to dispose the assets. The 10 naira is needed for the purpose of disposal of the assets. You cannot write off your assets completely from your book, you must always retain 10 naira in your book. Okay, that is that. We move on to disposal of qualifying capital expenditure. Now, ordinarily, when an asset is acquired, such an asset is also expected to be disposed or be used till the end of the useful life. Now, when an asset gets to the end of its useful life, such an asset probably maybe is not working effectively again, or probably it has become obsolete, probably because you need more, you want to expand your business, and unfortunately the current machine that you are using cannot meet your production targets. Therefore, the need to replace the assets will come into mind. And in the replacement of the assets, that means such an asset that you are planning to replace, you must have in mind that you are going to dispose it. Okay. And when you dispose such an asset, there's what we call balancing allowance and balancing charge that will arise from the disposal of assets. So disposal will always arise for some reasons. What are the reasons? One, we have said you want to increase your production capacity, and the current asset that you are using cannot work in that space. Cannot what? Work in that space, cannot be used. Because of that, you have to replace the assets. Because of that, you have to replace the assets. Number two, we say the asset has become obsolete. It's not currently meeting the need, or there are new technology that is in place. Then we need to what? Dispose the assets. We need to dispose the assets. Or the asset is theft, fire incidents, or natural disaster. So those are the reasons. So we now say, for the purpose of disposing assets, what is the tax implication of that in tax? When an asset is disposed, we are going to be comparing the disposal value with the tax written down value at the point of disposal. That is, when an asset is disposed, the disposal value, that is the sales proceeds, you'll be comparing it with your tax written down value at disposal. Tax written down value at disposal. It could either be a situation where you make profits or a situation where there is loss. Every one of you in this class today, remember when we were discussing profit and loss adjustments, where I told you loss on disposal of fixed asset is not allowed, while profit on disposal of fixed asset is not taxable. There is another way in which that profit will be taxable in Companies Income Tax Act. And this other way which will be taxable is on balancing charge, when you have balancing charge and when you have balancing allowance. So I'm going to be talking about balancing charge and balancing allowance in the subsequent paragraphs. What is balancing charge? Balancing charge will arise where your sales proceed exceed your tax written down value at disposal. The sales proceed exceed tax written down value at disposal. Okay? Exceed tax written down value at disposal. That is a balancing charge. That is, your sales is more than your tax written down value. You will have balancing charge. Any question? Now, if that is the case, what is the treatment of balancing charge?
Yeah, sir, please, sir, before you proceed, sir, I have a question, sir.
Go ahead.
As regards this computation of capital allowance, though quite understood regarding when asset is being purchased, but in a situation whereby we are having a pioneer period, whereby instead of acquiring assets, but we have total written down value that was initially given in question. And in addition to that, we are having some assets that is being acquired in the course of the business. So my question now is, how do we apply the initial rate and annual rate? Should we apply it on the total written down value of the asset or on the new additions of the assets, sir?
Thank you. So under this capital allowance, we are still going to look at the topic where we say asset acquired on a going concern basis. Okay. Now, when you acquire an asset when the business is already in existence, or you are given a question about a company that has been existing and you're just told that they have a tax now value or so amount, your own what you need to do is that you need to also check for the total number of expected useful life of the assets, the expected useful life of the assets, and the number of years the asset has already been used for, and the remaining number of years that the asset has to use, that is unexpired useful life of the assets. So in that situation, examiner will give you when the asset was acquired. So it is not left for you to understand. It is not left for you to understand the total. It is not left for you to understand the total useful life of the assets. So take, for example, if an asset is supposed to use 5 years, but examiner now gives you tax nominal value at the end of the second year. You know that the remaining years is 3 years. All you just need to do is to divide the tax nominal value by 3 years, because you remember, we said annual allowance is calculated on a straight line method. So it's going to be constant. You just divide it by 3 years. On the new asset that you acquired, you need to calculate, on the new asset that you acquire, you need to calculate the annual allowance and the initial allowance on the new assets acquired. Do you understand?
Yes, sir.
Yes.
So, excuse me. Oh, sorry.
Yeah.
I don't know. Is he continuing with the question, or should I ask?
Go ahead with your question.
Go ahead.
Okay, all right. I think that's a question in the ICAM pack, I think 2022, May or thereabouts. So there's this question, they said, there's this analogy they gave that tax written down, they brought down tax written down value, of an asset, but it wasn't specified. Then at the footnote of it, they now brought down the names of the whether the same asset, I don't know, assets, like motor vehicle, furniture and fittings, and then plant and plant and machinery also. So they now brought down their balances. So what I'm asking now is, at the schedule, do we now need to bring up tax written down value, the value they brought it from? I don't know where they brought it from. And are we meant to record it on that schedule? Now, yes, bring down again these other assets that are remaining from what was given. The asset was 2018 or thereabouts. So for the motor vehicle, it was meant to remain 1 year. Then for furniture and fitting, it was meant to remain 2 years. Now, before now, they bought new assets. How do we treat such?
So the one that remains 2 years, you will divide it by 2 years.
Okay,
to
that's
get the annual allowance.
The tax written down value will divide it by 2 years. Okay.
2 years. 2 years is left on that asset. You divide it by 2 years. The one that it remains 1 year.
Yes.
It is equal to the annual allowance for that year. You remember?
Okay,
That
so
is,
we now subtract 10 naira from it.
Madam Blessing, your head is
Sir.
there. Your
Sorry?
head is there. Your head is there. You are correct.
Okay, sir. Then what happens to the tax written down value of this other asset that wasn't specified?
They would have told you when they bought it. Except I see the question, they would have told you the year it was bought, or if they did not tell you the year it was bought, they would have also told you the number of years remaining. Do you understand me?
Yes, sir.
Examiner will not just give you a question that without telling you when the asset was bought in this scenario, or if they did not tell you when it was bought, they will tell you the number of years remaining, or the number of years in which the asset has been used before now. It is now left for you to know the statutory number of years the asset is supposed to use. When I say statutory number of years, building statutorily under company income tax is supposed to use 10 years. Statutorily, supposed to use 10 years. Let us now assume that the building had used 4 years before now. It now remains ordinarily, let's say it has used 4 years. They told you, examiner told you that the building was acquired 4 years ago. And in this current year, it remains how many years for us to use the asset? 6 years.
Yes.
So that tax value, you just divide it by 6, and that will be all.
Okay, now for the computation of the tax liability, do we bring down that tax written down value of this other the other ones that was given, bring that down, then add the capital allowances of these remaining years to
For the new one, so for each of the years, you calculate capital allowance of different years separately. So you don't merge capital allowance together. Are you getting it? So when you calculate capital allowance for 2022, you can only take that capital allowance against 2022 profits. Okay? If you are unable to recover that capital allowance fully in 2022, you carry forward to 2023. Okay? The 2023 one, you will bring it in, add it together with the balance brought forward, and the two will be removed from the profits. Do you understand me? So that's how to
Yes,
go about it.
but a situation where the profit is able to absorb the total of the capital allowances, do we lump them together to remove it from the
provided the company is a manufacturing company. We are still going to get there. In a manufacturing company, there is no restriction to the amount of capital allowance you can claim. But in a trading company, there is a restriction. We will get there.
All right.
Just give me, as we move on, you will see all these things I'm talking about.
All right, thank you, sir.
All right, a quick one from my side, sir.
Okay,
I have a
Fidelis.
question too. Okay, my question is this. My own question is a bit practical. I resume an office where there is incomplete record of the asset bought, and you can't really get the amount and the purchase deeds. You had for some, you don't have for some. So in that scenario, what do you advise I do? Because there was no proper transition of role from the previous accountant to the current accountant. I can't find most record anywhere. Do you advise I do estimation of the asset items and then calculate my capital allowance and then move on?
Okay, thank you, Fidelis. You cannot do an estimation of an asset now. How do you want to do it? The only thing you can do, I don't know, it's going to be very difficult for you to claim capital allowance on that, because when tax authority comes, they might want to see the receipt of the assets and when it was acquired. You get. So it might be very difficult. It might be very difficult because except if in the past you can actually show evidence that these assets we have not claimed capital allowance on it. And You can also look for the market value of the assets and agree with the tax authority that this is what you want to do before you start doing it. Because it's going to be very difficult for you to claim that capital allowance on the asset because they will ask for evidence of purchase receipts.
Sir, in also to that, Fidelis.
Go ahead, Danny.
I'm here.
So in order for you to check if there is no any proper transactions, I believe that there is bank statement. You can go back to the bank statement historically to check the cost of the asset and when it was bought. So from there, you can use that to get the original value of the asset acquired.
Thank you, Aniboshe. That is a very good one. Thank you.
Much appreciated, sir.
Thank you. Okay. So the next one that we're going to be looking at is treatment of balancing charge. Who can tell me what balancing charge is? I already said it before the question started coming.
We said that sales. When the sales is more than the tax written down value.
Madam, when I see you next week Saturday, I will give you something.
Okay, Mr. Give me something too. Okay, it's when disposal value and see the total written down value of the asset.
So Madam already said it. So you are not. Okay. All right. So let's now talk about the treatment of balancing charge. When you talk about balancing charge cannot exceed the total allowance claimed on the asset disposed. Are you listening? It cannot what? Exceed the total allowance claimed on the asset disposed. Where this occurs, the taxpayer must restrict the balancing charge to the total capital allowance claimed on the asset. Do you understand what I'm saying?
Please repeat.
So I said your balancing charge cannot exceed total capital allowance claimed on the asset. But if peradventure your balancing charge exceed total allowance claimed on the asset, you must restrict it to the total allowance claimed on the asset. Okay, let's look at an illustration. An asset has a tax value of 900,000. So we are given total capital allowance claim on the asset is 233,333. Sales proceed is 125,000. So calculate the balancing charge for me, everybody. What's balancing charge? What is the balancing charge?
350,000.
250,000.
350.
250. Good. Now it's 250,000 for our balancing charge. But you remember, who is not getting 250,000?
Size 350. 350.
350. Thank you. Okay, if it's 350, from the principle that we talked about, we said your balancing charge shall not be more than total allowance claimed on the assets. So what did I say that we are going to do if it is more?
We restrict it to the total capital allowance claimed.
Prosper, in our next online class, I will give you something.
Thank you, sir.
You like free thing. So we will restrict it to what? Total allowance claimed on the asset. Therefore, I will restrict it to this value. Do you understand me? Any question on that?
Sorry, sir, I don't think I've understood it. Thank you.
Yeah, thank you, Madam Blessing. So what is your balancing charge when you calculate it, Madam? Madam Blessing, what is your balancing charge?
Is it like is 1 million? The sales produce is 1,250,000 minus 900.
What did you get?
I've not done that. 1,250,000 minus 900 is 350, sir.
From the principle of balancing charge, what did we say? We said balancing charge cannot be more than total allowance claimed on the assets.
Yes.
So if it is more, what do? We restrict it to the allowance claimed. Therefore,
Okay.
we are to this.
Okay, sir.
Good. That's what we have done here. I'll put a note there. The next one. In case you want to calculate the allowance claim on the asset and you are not being given, so you will say total cost of acquisition of the QC, this is it, less tax nominal value at disposal, this is it. Total allowance claim on asset disposed, this is it. Do you understand? So this is how to get total allowance claim on the assets disposed. So let's go to the next illustration. So the following information relates to the asset schedule of Alisi Nigeria Limited. Sales proceed, 10 million. Cost of acquisition, 7.5. Tax nominal value at disposal, 3 million. Who is calculating for me the balancing charge? What's my balancing charge in this question? What's my balancing charge in this question?
Should be 7 million.
7 million, good. What's the total allowance claimed on the assets? Who can tell me?
Costs.
Elena,
4.5
Yeah.
million.
what's the total allowance claimed on these assets?
That's cost minus 7.5 minus 3,000. That's
3 million.
4.5.
4.5.
4.5.
Yes.
So can we charge the total capital, total balancing charge of tax? Can we charge total capital balancing charge of tax?
No,
No. Why?
because the cost of acquisition is lower than, I don't know how to explain.
Go ahead, Judith. You are on the point.
Because the cost of acquisition is lower than the sales proceeds. So you restrict it to the lower of cost and sales proceed. Do you understand?
No, you have mixed it up. The cost, yes, who is saying this? Who is helping us?
Right, because the capital allowance is lower than the balancing charge.
Yes, the capital allowance that we are supposed to claim is lower than the balancing charge. Therefore, what do?
We restrict it to the
Capital allowance.
We restrict it to balancing to the capital allowance. Abi? So if I say my sales proceeds is 10 million minus tax nominal value, we have 7 million. My balancing charge is 7 million, right? But we need to get the total allowance claimed on the asset. 7 million, 7.5 million minus 3 million, we have 4.5. That means we take the lower of the two, right? So that is what we have done. So look at it. 7 million. So the lower of the two is 4.5. We restrict to what? 4.5. Do you have any question?
Very clear, sir.
Good, Fidelis. Thank you. Now we move on to the next one, which is balancing allowance. Balancing allowance is the opposite of balancing charge. That is, in terms of balancing allowance, we said your balancing allowance will arise where your sales proceed is less than the tax nominal value at disposal. That is, your sales proceed is not up to your tax nominal value. So to the taxpayer here is like a loss to them. they've made loss. They acquire an asset for 10 million. When they are selling the assets, they are selling for 3 million. So that means your sales proceed. Sorry, yeah. No, they acquire an asset for 10 million. The taxing down value of the asset, as at the time they want to sell it, was, let's say, 5 million. And they sold it for 3 million. That means they have made loss. You sold it for 3 million, you acquired it for the taxing down value at the point of disposal was 5 million. 2 million loss. So if that is the case, we say that is balancing allowance. Now, balancing allowance, unlike balancing charge, does not have restriction. You don't restrict it because it is additional allowance to be claimed by the taxpayer. That is the purpose of all these things I'm saying here. So let's look at this illustration, for example. Assume an asset has a taxing value of 1.9. Both initial allowance and now allowance is what? Is 233,000. Sales proceeds is 1,250. Calculate the balancing allowance. What's my balancing allowance? Who can tell me? Who can tell me? What's the balancing allowance?
650,000.
650,000. 650,000. Happy?
Yes.
Yes.
Okay, good. Both capital allowance, initial allowance, and another allowance claim was 233. So does this have any implication?
No.
No,
It does not, because now the balancing allowance that you get is an additional allowance to be claimed by the taxpayer. So because 650, so total allowance to be claimed by this taxpayer will be 650 plus 233,000. That will be the total allowance to be claimed by the taxpayer. The next one. The following information relate to asset schedule of Mega 99 Nigeria Limited. Sales proceed 1.5 million, cost price.
Sorry, sir, excuse me. Could you go back to this other, the former illustration? The sales proceed is 1,250,000, and the tax written down value is 1,900,000. The balancing allowance, that is tax written down value minus the sales proceeds gives us sales minus tax written down value gives us negative of 650. So he said we should add it to what?
Your total allowance to be claimed this year will be 650 plus this. Plus total, plus both initial allowance and annual allowance that you have. Do you understand?
Okay, so what is the tax implication there?
The tax implication is that balancing allowance is an additional allowance. So, we said we have initial allowance and annual allowance before, Abby.
Yes,
so
please.
Now, balancing allowance is an additional allowance to both initial allowance and annual allowance that we already have. So we had it together and go and review it against our profits.
Okay, so it's for the benefit of the taxpayer. All right, thank you.
The other one is the tax authorities that will charge it, balancing charge. But this one is taxpayers that will use it to reduce their tax liability.
Okay. So are you going to give us this?
I'll forward it to you. Don't worry. I'll forward it to your class.
Okay.
My online student already has this. So it's only your class that does not have this. Okay, we move on. So we said Mega 99 acquired an asset for 10 million, sold the asset for 1.5. At the point of disposal, the value of the asset was 3.750. Can put the balancing allowance. So go ahead. So let's go. In computing our balancing allowance, we say sales proceed
2,250.
2,250. 2,250, 1.5. Now, the next one is total cost of the assets was 10 million. Tax written down value at disposal was what's it called? 375. So total allowance claim on this asset is what? 606,250,000, Abi?
Yes, sir.
Just like I told you the other time, the total allowance that this taxpayer will claim on this asset will be 6,250,000 plus this. Look at my explanation here. From the above, the taxpayer will claim 6,250,000 as initial allowance and annual allowance, and also claim balancing allowance of 2,250,000. By implication, the total costs, the total of 8.5 million will be made available for relief against the profit of the taxpayer, isn't it? As a result of this loss made, 1.5 million sales proceed will also be exempted from tax, making it 100% relief against the profit of the taxpayer. Because you remember, we said profit on disposal of fixed assets is not taxable. Abi, by understanding this taxpayer, we have 100% relief. The taxpayer, we have 100% relief. Because we said profit on disposal will be what? Will be exempted. Sales on fixed assets is not taxable under company income tax law. Abi? So that is gain for the taxpayer. Also, when the taxpayer disposes these assets, the taxpayer makes loss. Okay? Now, in the process of making loss, the taxpayer already under the tax law will be granted a relief of 6,250,000. Abi? And also, when the capital allowance, when the asset was disposed, the taxpayer made a loss of 2,250,000. Abi? So when you add all this together, 8.5 million will be relieved against the profit and simple profit of the taxpayer, and 1.5 million will be exempted from tax. By implication, this taxpayer is gaining 10 million as tax exemption. Do you understand? Any questions? In the absence of no question, we move on to the next one. We will do this one by the grace of God today, because we did not do it last class. Any question?
Sorry, sir, please, can you recap the last part?
Okay, let's start from here. Remember when I was teaching you profit and loss accounts, trading profit and loss adjustments, that is adjusted profit. I told you sales of fixed assets is not taxable. Put that at the back of your mind. We also explained in this class today that your balancing allowance is going to arise where your sales proceed is less than your tax minimum value at disposal. And the taxpayer will have right to claim this on the profits. Abi? So when we subtracted this and this the other time, we had 2.250. This is an additional allowance to be claimed by the taxpayer. But you remember that the taxpayer will also be granted allowance on the asset acquired in form of capital allowance and in form of initial allowance and annual allowance. Abi? So, and I told you how to calculate allowance claimed on the asset. I said it should be your total cost of acquisition less your tax minimum value at disposal. You will have this. So this is the total allowance that the taxpayer will claim ordinarily on the asset before the asset is being disposed. Now that the asset has been disposed, the taxpayer is making loss on disposal, which is 2,250,000. If I add this and this together, I will have 8.5 million. This taxpayer will be claiming 8.5 million as one initial allowance, annual allowance, and balancing allowance. Your balancing allowance is 2 million. Your initial allowance and annual allowance gave us 6 million, all right? So if you add it together, you have 8.5 million. So the taxpayer will be claiming a total of 8.5 million as relief. That's in one hand. On the other hand, this taxpayer also would also be claiming, will also be exempted rather from taxing the sales proceed. You don't tax sales proceed under company income tax. You don't tax it. Okay? Therefore, the taxpayer too will be exempted from the tax on the sales value of the assets. So by implication, we say this is exempted from tax. This will be given to the taxpayer as relief. This will be given to the taxpayer as relief. So by implication, the entire 10 million will be a kind of tax relief to the taxpayer. We move on to the next one. This is where we're going to stop today. We are going to do this capital allowance on carry backward. Now, carrying backward of capital allowance upon cessation of a business. When a company ceases operation, such a company has rights to carry backward its capital allowance for a maximum period of 5 years after the year of cessation. Okay? Now, before the year of cessation, rather. Carry it backward for a maximum period of 5 years before the year of cessation. That is, if the company ceases operation 2025, the company can carry backward to 2020, up to 2020 to relieve its profit against the profit, to relieve the unrecouped capital allowance upon cessation against the profits. Therefore, so any unrelieved profits within that 5-year space shall become lapse. The taxpayer will not be able to carry backward again. It will become lapse. Now, what is the tax implication for the carry backward of capital allowance? It is expected under the law that the FIRS refund the taxpayer of all the tax that has been paid on the profit of those years. So that is that. So let's look at an illustration. Martins PLC ceases trading in 2022 year of assessments. During the
Sorry,
year,
sir.
yes, go ahead.
You said that the taxpayer would, FIRS will pay back what is being due to the taxpayer. But in real life, the FIRS never pays back.
In real life, now we are talking about the principle.
Okay. Right.
FIRS only. No, they return money now. You get FIRS don't return money.
Yes, sir.
So that is that. So let's go ahead. Martins PLC ceased trading in 2022 year of assessments. During the review of income tax and capital allowances computation for the year of assessment, for the year of cessation, it was discovered that the company has an unabsorbed capital allowances of 1,250,000 on the date of cessation. The spread of total profits for the 5 years before the year of cessation is as stated below. You remember, this company ceased when? 2022. So we are given the profits, 5 years profit before the year of cessation. 1, 2, 3, 4, 5. Okay? 1, 2, 3, 4, 5, 6. We are given 6, but we don't need up to 6. We don't need up to 6. We only need up to 5. So let's go. So the examiner now say, demonstrate the option available to your clients to recoup the unabsorbed capital allowances of 1,250,000. Determine the tax refundable by the Federal Inland Revenue Service for the relevant year of assessment, if any. So the first thing you will do is to write the tax years that will be affected, total profit, capital allowance brought forward, capital allowance available for the year, and capital allowance carried backward. So let's go. In 2021, don't forget, in 2022, this company has an unrelieved capital allowance that they want to carry backward. So in 2021, I have a profit of 1,250,000. The unrecouped capital allowance that I'm bringing backward to against this profit is 1,250,000. So the capital allowance I'm able to recover from the profit is this 1,250,000. Abi? So the balance, that is this minus this that I've recovered now will be 1,000,150. In 2020, there was no profit, but I'll bring this one, I'll bring it backward again, carry it backward to 2020 to go and see if there is profit. If there was profit, I would have taken it from it, but there was no profit. So I'll carry this one backward again. I'll carry backward. But in this year, there was profit of 322,500. That profit, I'll take the entire profit back. I'll take the entire profit back. So I will have 815. That is this minus this. I will have 815. I'll bring my 815 back. This year is the fourth year that I'm carrying backward. They did not make profits. So I'll carry this one backward again. So in 2017, which is the last year, they made profits of 750. But I still have an unrelieved capital allowance that I brought forward from the previous year to this year, which is 815. So I'll take the entire 750. So this 650 that I'm not, 65,000 I'm not able to recover has become lapsed. I cannot recover it again. Even though we saw that they made profit in 2016, I cannot take advantage of 2016 because the law says it has to be 5 years. Any question? So if that is the case, I have written in the comments here, the capital allowance of 650,000 will be deemed unabsorbed and become lapsed as it has exceeded the maximum number of years required by the Act. Capital allowance carried backward against the profit will be recovered from FIRS at appropriate rates. So let's calculate what we are going to carry backward against it. You know, on all these profits, we have paid tax on it. So we want to get the tax refund back from government. So you remember in the first year, we took back against our profits this guy. This 100 and this guy. You remember we took this guy back. So the tax that we have paid on this will be refunded back to us. We have paid 337,500 on this profit. In 2020, there was nothing. But in 2019, we recover back this value. What is the tax that we have paid to government on this value? At 30%, we have paid 96,000. In 2018, there was nothing. So we are not recovering anything. But in 2017, we have recovered 750. But what is the amount of tax that we have paid on this? 30% of that is this. So if I add the total of this together, I will have 355,500. That is the entire amount that the tax authority will refund the taxpayer. They are supposed to refund this taxpayer 335,500. 355,500 is supposed to be refunded to the taxpayer. Will the tax authority oblige to this law? Currently in Nigeria, I don't think so. But ordinarily, they are supposed to give this taxpayer this amount that has been paid back to the taxpayer. That is it on the carry backward of capital allowance. Any question? Okay, if there is no question, we go straight to restriction of capital allowance. Restriction of capital allowance. Basically, there are two types of companies that we're going to be looking at in this restriction of capital allowance. Number one, we'll be looking at companies that is into trading activities other than agro-allied and manufacturing business. And we'll also be looking at companies that is into agro-allied business, that is agricultural business and manufacturing business. For companies in trading organization or trading businesses, their capital allowance is restricted to 66 to 12% of the accessible profit. It's restricted to what? 66 to 12% of the accessible profit. Your capital allowance cannot be more than 66 to 12% of the accessible profits. Okay, that is capital allowance for you. Meanwhile, for manufacturing company and trading company, your capital allowance shall not be restricted. There is no restriction. You don't restrict capital allowance for this kind of company. Okay, that is that. You don't restrict capital allowance for this type of company. Capital allowance is not restricted. It is granted in full to the taxpayer that is into this company. Note that you can also carry capital allowance forward indefinitely. 2022 Finance Act, 2020 Finance Act define what agricultural production means. Talks about the production, primary crops production, primary livestock production, primary forestry production, primary fishing production, and so on. So you will read all those on your own. Now, let's quickly look at this. In the next 10 minutes, we'll be out of this class because you have another class now, right? What time do you have another class? You are not
10:30, sir.
10:30. Okay, in the next 10 minutes, we'll be out of this class, okay? Sorry, permit me. So you are given the following scenario of fixed asset schedule of Tumino Limited, where accessible profit is 100,000 and capital allowance 75,000. Accessible profit is 500,000 and capital allowance 830. You are required to complete the total profit for the two scenarios above. If the company is not about to above. If the company is a manufacturing or trading business, manufacturing or agricultural business, number two, if the company is a trading business. Okay. So if that is the case, we move ahead to talk about that. So we first take the first scenario. The first scenario is the company is a trading manufacturing company. And the second one is the company is a trading company. So let's look at it. So if the company were to be a manufacturing company, we said, you remember, 100,000 is the accessible profit and capital allowance of the company is 75,000. You remember, we said for the accessible profits for manufacturing company, rather, you don't restrict the capital allowance. Therefore, they will claim everything. But for trading company, capital allowance is restricted to 2/3 of this accessible profit. That is 2/3 of this. We give this. So that is the maximum a trading company can take. 2/3 of this. So I will have 2/3 of my profit. So the profit accessible to tax for trading company here will be 33,000. Why? The profit accessible to tax for this will be 25,000. We go on to the next one. Illustration next. We said the company has an accessible profit of 500,000, and again, they have a capital allowance of 830,000. You remember, we said capital allowance for a manufacturing company, they can claim everything. So they will claim the maximum they can claim here, okay, is going to be the entire profit. They will take all the profits for the manufacturing business and carry forward the remaining. Meanwhile, for trading company, the trading company cannot take everything. They will have to restrict it to 2/3 of the accessible profit. 2/3 of this will give you this. So the balance will be carried forward. And meanwhile, look at this scenario. They are not paying any tax because there is no profit. But look at this scenario. This company will be paying tax on 166,000. On 166,000. So that is this. That is that. So let's go. In the first scenario, it will be observed that the company, that the capital allowance for the manufacturing was not restricted to their stable profits. That is, the entire amount of the capital allowance was claimed by the taxpayer without restriction. On the other hand, for the trading company, the maximum capital allowance claim cannot be more than 66 to 12% of the accessible profits. So we restricted it to 66 to 12%. of the stable profit. In the second scenario, the capital allowance is more than the stable profit for the manufacturing company. Therefore, the maximum capital claimable is related to the what? To the profits of this. On the other hand, the maximum allowance cannot be more than 66 to 2% of the stable profit. That's what we have done here. So that is that. When we come in the next class, for those of you online, this is where we are going to start. For the online students, we start here. For my physical students, we also start from this question. If you have any question, please do not hesitate to ask me.
I have a question, sir.
Go ahead.
So this restriction of capital allowance for trading business to 66 to 30, right? Does it occur when the capital allowance happens to be up to the 66%? Like in a situation where the capital allowance is below that amount, do we still
Just take
charge
everything. You just take everything. You just take everything.
Okay.
You don't restrict it. Any other one? Okay, I want to greet everybody one after the other before we end the class. I greet you. Angela, I greet you. Anifowoshe, I greet you. Pastor Tunde Aremu, I greet you. Madam Blessing, I greet you. Blessings, I greet you. Eyis, I greet you. Fidelis, I greet you. Bemi Sola, I greet you. Jermaine, I greet you. Gloria, I greet you. Afsat, I greet you. Elena, my sweetheart, I greet you. iPhone, I greet you. Judith, I greet you. Mufoniso, I greet you. Miracle, no the tire Jesus, I greet you. Naomi, I greet you. Nicholas, I greet you. Nne, I greet you. Obia, Nkem, I greet you. Ojobola, I greet you. Prosper, I greet you. Praise, I greet you. Shaka, I greet you. Sony, I greet you. Timilani, I greet you. Godwin, I greet you. Victor, I greet you. Is that my Victor? Victor, how are you?